Welcome to our deep dive on one of the toughest personal finance decisions. Using an extra $10,000 to $20,000 to pay down a high-rate mortgage or to maximize tax-advantaged retirement accounts. We'll compare the guaranteed return of paying off a 7% mortgage against the long-term growth and tax savings of accounts like 401k, IRA, HSA, and a solo 401k for those with side income. Along the way, we'll build a hybrid strategy that captures tax benefits now while still attacking debt. First, let's preview the roadmap. Here's our agenda. We'll start with the core conflict, then explore how tax-advantaged accounts create an edge, followed by a practical hybrid approach. We'll also cover liquidity considerations, do a quick math walkthrough, and visualize the decision with diagrams. Then, we'll test your understanding with 2 short quizzes, and finally wrap with key takeaways and next steps. With that, let's begin with a brief disclaimer. Before we proceed, please note this video is for education only and is not financial, tax, or legal advice. Everyone's situation is unique, especially when multiple income sources and various account rules are involved. Please consult a qualified professional before making decisions. Now, let's move into the core conflict. The core conflict is between 2 compelling choices: paying down a roughly 7% mortgage, which delivers a risk-free, after-tax equivalent return equal to that rate, versus maximizing tax-advantaged retirement accounts, where the combination of tax savings, long-term compounding, and market potential can outpace that 7% over time. With that frame in mind, let's visualize the decision. This diagram shows the decision tree. If you direct the surplus to extra mortgage principal, you effectively lock in a risk-free return comparable to the mortgage rate after tax, reduce your balance, and gain psychological relief. If you instead maximize tax-advantaged accounts, you gain an immediate tax deduction on traditional contributions, keep annual contribution space that otherwise disappears, and benefit from long-run market returns historically estimated around 8 to 10% over decades. Missing those contributions now permanently reduces your future nest egg due to lost compounding time. Next, let's detail the accounts that make the tax shelter path so powerful. Here are the primary tax-advantaged accounts. First, the 401k or 403b from your employer, which may offer a match and can be pre-tax or Roth. Second, IRAs, either traditional or Roth, each with its own income and deductibility rules. Third, the HSA for those on high-deductible health plans, offering a rare triple tax advantage. Finally, for independent contractor or sole proprietorship income, the solo 401k permits both the employee deferral, subject to aggregate limits across all plans, and the employer profit-sharing contribution. These vehicles work together to reduce current taxes and grow wealth efficiently. To ground this, let's look at example limits. Remember to verify current year figures. These are example 2024 limits. The 401k employee deferral limit is $23,000, with a $7,500 catch-up if you're 50 or older, and it's shared across all employer plans and any solo 401k. The solo 401k employer contribution can be up to roughly 20% of net self-employment income for a sole proprietor, or 25% of W-2 wages from your own corporation, all within the overall plan cap. The overall 401k plan limit is $69,000, or $76,500 with catch-up, combining employee and employer contributions per employer. Traditional and Roth IRA limits are $7,000 with a $1,000 catch-up, subject to income and deductibility rules. The HSA contribution limit is $4,150 for individuals, or $8,300 for families, with a $1,000 catch-up. Please verify current year limits before acting. With the foundation set, let's build a practical hybrid plan. Here's a balanced approach. First, shore up your emergency fund and clear any high-interest credit card balances. Second, identify your marginal tax bracket so you can quantify the value of pre-tax contributions. Third, fill tax advantage space in a logical order. Fund an HSA if you're eligible. Then consider IRA or backdoor Roth strategies as appropriate. Then ensure you've met your 401k employee deferral limits across all plans. And finally, target the solo 401k employer contribution from your contractor income. Fourth, automate these contributions throughout the year to reduce market timing risk. Fifth, direct remaining surplus toward extra mortgage principal on a consistent monthly cadence. Sixth, reassess each year to reflect income changes, updated contribution limits, and potential refinance opportunities that could lower your mortgage rate. Now let's compare the paydown path with the tax shelter path head-to-head. On the left, extra mortgage payments deliver a guaranteed return roughly equal to the mortgage rate after tax, shrink lifetime interest costs, and provide a simple, emotionally satisfying path. However, equity is illiquid and difficult to access quickly. On the right, maximizing tax-advantaged accounts provides immediate tax savings, preserves annual contribution room that's otherwise lost, and positions assets to compound over decades, often outpacing a 7% rate. Additionally, diversified retirement assets offer more flexibility than home equity. With that comparison in mind, let's sketch a timeline for executing the hybrid plan across a typical year. This timeline illustrates a year-long cadence. In the first quarter, verify your emergency fund and eliminate high-interest debt, while starting HSA funding if eligible. In the second quarter, complete IRA or backdoor Roth contributions, and check that your employer plan deferrals are on track. In the third quarter, estimate your solo 401k employer contribution from contractor income and begin funding it. In the fourth quarter, true up all contributions to hit annual limits, direct any remaining surplus to extra mortgage principal, and evaluate refinance opportunities. Next, let's dive into liquidity and why it matters so much. This sequence diagram highlights cash flow and access. Extra mortgage principal converts liquid cash into illiquid home equity that usually requires refinancing or selling to access. By contrast, diversified retirement assets preserve more optionality for future planning, though they do have access restrictions, potential penalties, and loan rules that must be respected. Maintaining flexibility can be valuable, especially in uncertain environments. Additionally, if rates fall and you refinance later, the opportunity cost of having prioritized mortgage paydown increases. With liquidity addressed, let's run through a quick, markdown-style math example to cement the intuition. Let's quantify. Suppose your mortgage rate is 7% and you have $15,000. Paying down the mortgage delivers a risk-free return approximating that rate by preventing interest accrual. Alternatively, if you contribute $15,000 pre-tax and you're in a 24% bracket, you lower your current tax bill by about $3,600. Left invested at, say, 8.5% for 25 years, that contribution can grow to roughly $87,000, illustrating the power of compounding. A balanced hybrid might allocate 70% to tax-advantaged accounts and 30% to extra mortgage principal, as the pie chart depicts. The practical rule is to avoid forfeiting annual tax-advantaged room first and then direct remaining funds to the mortgage. Now let's test your understanding with a quick quiz. Question: which advantage of tax-advantaged accounts is impossible to recover if missed this year? Options: A. Lower mortgage interest next month. B. Use it or lose it annual contribution space. C. A higher credit score. D. A guaranteed 7% return. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. Use it or lose it annual contribution space. If you skip it this year, you permanently lose that room and the compounding runway associated with it. Next, one more question to solidify the decision framework. Question: with a 7% mortgage and long-term expected market returns near 8 to 10%, plus immediate tax savings from pre-tax contributions, which strategy generally takes priority for most investors? Options: A. Only pay down the mortgage. B. Only invest in taxable accounts. C. Maximize tax-advantaged accounts first, then apply surplus to the mortgage. D. Hold cash and wait. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is C. By prioritizing tax-advantaged space, you lock in immediate tax benefits, preserve annual contribution room, and harness compounding. After that, directing remaining cash to extra mortgage principal delivers a strong, guaranteed return. Now let's consolidate the key points. Remember these points. First, paying down a 7% mortgage is a strong, guaranteed after-tax return. Second, tax-advantaged accounts offer immediate tax savings and long-term compounding. Third, annual contribution limits expire each year and cannot be recovered. Fourth, liquidity and flexibility often favor retirement and investment accounts over home equity. Finally, a hybrid plan lets you capture tax benefits while still reducing debt. And to close, Here's a concise summary and your next steps. Summing up, prioritize funding tax-advantaged accounts within the rules HSA, IRA, or backdoor Roth where appropriate, 401k deferrals across all jobs, and solo 401k employer contributions from contractor income. Automate funding and check progress mid-year and at year-end. Then, channel remaining surplus into extra mortgage principal. Reevaluate annually and consider refinancing opportunities if rates decline. Always verify current year limits and coordinate employee deferrals across plans. Finally, let's wrap up. Thanks for watching. If this video helped clarify your decision, please like it, share it with someone weighing the same choice, and subscribe for more practical, numbers-first money content. In the comments, tell us your plan. Are you prioritizing paydown, tax shelters, or a hybrid? We'd love to hear your thinking.